Hello guys, thank you very much for joining in. We're going to be starting out with the second chapter of your environment alternative investment topic, which is the introduction to alternative investment. In that, the chapter name is environment of alternative investment. That means they're talking about the market. Okay, they're talking about the market. Now there are a few sections in the chapter which is important, which I'm going to mark it as star also. So please mark it as star in your books also. Look at the first section, where they're talking about what are the different types of participants in the market, buy side, sell side, and different participants in the market who are facilitating the market. That is basically being covered in detail in this first learning objective. Okay. Now over here, the first section is buy side institution. Now we have given you the bifurcation also. What is buy side, sell side? So you can check here. This is a summary. Again, we'll be going into the each category in detail as we move ahead. But look at the first category. Who are the buy side institute? People who have huge amount of money available and who want to invest into the market. Insurance companies, pension funds, okay, hedge funds who want to take positions in the market, okay, who want to invest their money. Sell side, which is the other side. Generally, the market is bifurcated into buy side and sell side, okay. So they are financial institutions like broking firms, okay, who will help you to execute the trade. They will give you research. So they are sell side. Okay, buy side is somebody who has the capital, who wants to take long position, want to invest into the market. Sell side is the counterparty, or you can think of it as a participant in the market who is facilitating it. Okay, he is providing financial services. Over here, most of the time it's a bank or say a brokerage firm. Investment banks could also be over there in the sell side category. Yes. Service providers. Now there are dealers, there are depository. If you're doing a transaction into your exchange, so there is depository, there is custodian, okay, variety of players, agent bank who is sitting in between for different currencies. So there are variety of people who are there, who are providing some level of auditing, some level of consulting work, basically support service. And then there is regulator, who is basically looking at the overall market, who is making sure that there's no fraud, there's no mistake, there is no problem in the overall market. Okay, these are the bifurcation that we're going to be looking in the first learning objective. Okay, so look at this. Who is the buy side investor? Sorry, buy side institution. These are investors. Few examples of this. Okay, plan sponsorers. Okay, now this term is coming for the first time. Okay, so a lot of private organization, okay, they provide pension services, okay, to their employees. Okay, pension services to their employees. Government also provide pension services to their employees. Okay, so if you're working for a X number of years in that organization, you become a part of that pension program, and you after retirement you'll keep on getting the money. Okay, so who is the plan sponsorer? Who is actually funding that retirement payout? It's generally the company, the organization for which you are working. So if I'm working for a central government is going to pay some portion into that. So that is why they are calling it as plan sponsorer. Okay, who is basically investing money into that fund. Okay, and that fund, okay, from that fund the money will be paid to the employees, but it is not paid immediately, right? So for example, if government has allocated 5,000 crore rupees as into the pension fund. Okay, now people are going to retire over a period of time. So till that time, that money is invested into the market. Till that time, the money is invested into the market. Okay, their job, the plan sponsor job is to make sure that whenever people retire, the fund should have sufficient amount of money so that they can pay the pension. Okay, they can pay the pension. Okay, so first point, plan sponsorer. Look at the example, Tata Steel managing pension fund for its employee. Only who are employee or who were employees of Tata Steel, they can become a part of that pension fund. Okay, if I go and buy a pension fund which is available to general public, like Kotak also has a pension fund. Okay, so that is available to everybody in the market, not specific to any company. That's a different product. Okay, over here we're talking about the organization or the government who is providing a facility to its employees that will be providing you pension. This is the first part. Second, foundation and endowment. What is foundation? Bill and Melinda Gates Foundation, Azim Premji Foundation. So there are people, okay, there are people who are rich, okay, and they have donated certain amount of money into a foundation, and that foundation is going to do some philanthropic activity. Okay, so they might work towards child education or girl child. Okay, now that foundation, when they get the money, suppose Bill Gates has donated $20 billion. So that $20 billion is not immediately used for philanthropy, right? That is invested in the market, and then there is return generated from that $20 billion, and that return is actually used to do philanthropy. That is the logic. Okay, so these are generally used for non-profit activities, like I said, charitable activities. Endowments, these are connected to universities. Okay, so they have an endowment fund. So like I have given you example of Harvard. Okay, all the big universities in the world, they have their own endowment fund. So suppose if I am a pass out of that college or that university, I might donate certain money into that endowment fund. That endowment fund is invested into the market. They also buy alternative investments, asset. They invest into the market, and whatever is return coming out, that money will be used to run that university, to pay the salaries, infrastructure management and all of that. Okay, that is basically your endowment. Okay, answering to your query, can we consider employee provident fund as a plan sponsor? Kind of, yes, but it is not a pension. Okay, it is a mechanism created by the government so that there is saving being done by the employee. Okay, pension is a NPS, new pension scheme. You can think of that as a plan sponsor. Look at the third. I hope everybody is with me. Third point, family offices. Okay, so Mukesh Ambani. Okay, he has huge personal wealth. He has created an entity. Okay, and that entity is managing their own fund. Okay, that is family offices. So most of the family offices are registered in Dubai, Singapore. Okay, they have offices in India also. They manage funds of ultra rich HNIs. Okay, and they invest into startups, they invest into market. Okay, they buy real estate also. So through that one family office, I am able to better manage my funds. I am able to look at tax implication also, because entire family's fund is managed through that. Okay, so most importantly, they manage their investments properly. They do tax planning, estate management also. How my money will go to my kids. That is also done through that family offices. Next is private wealth institutions. What is private wealth institutions? So I have created a company, okay, which is managing my own fund. So this is not a family office. This is a company that I've created. Okay, dedicated company for my management of fund. That is also possible. Sovereign wealth fund. So Abu Dhabi, Dubai, okay, a lot of these governments, Canada also has it. They have their own funds. Okay, Saudi has a fund. Now that fund is basically the excess money that they've got, for example, by selling oils. They have collected that money, and that money is invested into market. So if you look at Qatar has huge investments into, that fund has huge investment into UK, London market. Okay, they have bought so many properties, so many companies through that. Okay, and why do they do it? Because that money, with that investment, will generate return, and that return will be used by the government for the benefit of the people. So if tomorrow there is a downturn in the market, that money can be used. Okay, so that money can be used to stabilize the economy during any crisis. So Norway has that fund. You have every country, more or less every country has that sovereign wealth fund. Okay, Shubham, GIC, we have talked about that. Private investment pool. See the word pool. Okay, that means there are investors coming in and putting the money, but it is not open to everybody. Okay, so very good example of this would be hedge fund, private equity fund, where very limited people, limited investors will contribute some money. That pool will invest into the market. Okay, so there is a private equity fund where suppose 50-60 investors have put 10 crores. Hedge fund, they have 70-80 investors who put some money, and that money is used in the market. Generally, these private investment pools are limited partnerships. Now you will understand that better when we go into this chapter in detail, where we talk about limited partners and general partners. Okay, but I'll just give you a gist to connect this topic. So you have to think it like this: there are investors who have capital available with them. 50-60 people, each with 10 crore rupees. Okay, and there is somebody who is a fund manager. Now I'm just giving you one example. It is not applicable to every case. Okay, they have created say a hedge fund where the investor is putting the capital, hedge fund manager who is called as general partner. Now there can be one fund manager, there can be multiple fund managers. Okay, they are called as general partner, also GP. The investors are called as limited partner, LP. Okay, now the fund manager or the GP will manage the fund. In some cases, they might contribute also a certain small amount. Okay, but they will manage the fund, and LP will only make an investment. They will only provide capital. Okay, and this is managed through a hedge fund, which is a limited liability partnership, LLP. Okay, or they create a partnership firm where limited partners are also there, general partners are also there. I'm just summarizing it again. Limited partners are somebody who are there with money, capital, but they do not have the expertise to invest into the market. That is where the general partners will come. They will manage the day-to-day activity, and they might contribute some money also, and they will get the management fee for running the fund. They will take the investment decision because they are expert into that field. Okay, that is the limited partnership structure where there is a limited partner and general partner. Okay, generally hedge funds are structured in this manner. So there is a long-term alpha fund which uses this kind of structure. Separately managed account. So it is like this. I have huge money available with me. Either I can invest my money into a pool like hedge fund, mutual fund, or else I can ask my manager, fund manager, to separately manage my money. So there is an account in which my money is only going, and my money is managed separately from the pool. Okay, it's not a pooled investment. It is only for one investor. So if you invest into PMS, portfolio management services, your money is separately managed. Okay, so there is a dedicated investment advisor who will basically tell you that where I am investing and all of that, but your money is not a part of that pool. Okay, so over here you have more freedom in terms of where the money is going to get invested. What is the overall profile of the investment? In a pooled investment, you do not have that much control. Suppose you invest into mutual fund, you cannot tell the fund manager that where are you investing. You cannot question him because the fund manager has already identified or told you that this is the general strategy that we are going to follow. Okay, I'm going to take a pause. Let me know if there is any confusion. I hope everybody is good. Are companies with asset under management considered buy or sell side? So mutual funds are buy side. They have money available, they are going to invest. They have asset under management. Right, Abhishek? Shubham, why would an LP go through a separately managed asset? So think of it like this. Shubham has 500 crore rupees available. He has invested 200 crores into a hedge fund, which is a pool. And he wants to make sure that remaining 300 crore has to manage separately. So it is a part of the strategy. Right, Shubham? We are moving ahead. I hope everybody is with me. Okay, why would somebody go for a separately managed account? If you want to be involved into the decision making, you want to know how the fund manager is taking decision, you have clarity. Okay, because in mutual fund, in hedge funds, they don't inform you every time that how they have performed. There is no direct access to the fund manager or person who is executing it, right? So over here, direct ownership of stocks and bonds is possible because it is my money and it is going through that one account. Whatever stock I'm buying, it is mine. If I'm going to invest through mutual fund, which is a pooled investment strategy, whatever asset they have purchased, the ownership is with the mutual fund because I'm not the only one who's investing. There are so many people, correct? Tailored investment strategy. I do not want to follow the standard approach which everybody else in the market following. I want a specific because I am an investor who has a residency of Singapore. Okay, or I have a residency of Dubai. I want to manage it accordingly. Or I US investor, I want to make sure that there is no double taxation. Right? So tax efficient strategy would be applied. Good amount of transparency. Okay. But look at the last point. There is no limited liability, because if tomorrow that fund manager who is managing your separately managed account, he makes a goof up, he purchases some asset which goes down, your entire money could go down. So over here, there is obviously a higher risk. There is benefit, so high risk is also there. Okay. Look at the example. You're hiring a asset manager to create your personalized portfolio. It is nothing but separately managed account. Let us go to this next. Okay, we have already talked about this. Now mutual fund and 40 Act fund is almost same. Okay, this is coming under the US regulation, but it is similar to a mutual fund where people are pooling money, and that mutual fund, say for example, Axis long-term investing, okay, long-term investment fund, 10,000 crore, 5,000 crore is very normal for them. They are going to invest that 10,000 crore in the market, and there are so many investors who put money, correct? So that is a pooled investment, okay, and this is very highly regulated in the market. Now some unique concepts, okay, undertakings of collective investment in transferable security. Okay, now this is equivalent of mutual fund in European market. Okay, equivalent of mutual fund in a European market, where they are saying, see, if you read the name also, collective fund means pool, transferable security means you can easily sell, like stocks, bonds. Okay, so it's like a mutual fund, but specific to European market, where retail investors can also participate. Okay, retail investors can also participate. But one unique aspect of this fund is that they also invest into other countries. That means they can get access to global market, global stocks. So a German investor, for like the example mentions, can buy a company in US, stake of the company in US, stake a company in India. So that is possible through these funds. Okay. Private limited partnership. Now this is what I have already talked about. Okay. Remember, there is a general partner, there is a limited partner. Okay. So I'm just going to zoom in this diagram. I hope you guys will be able to see it properly. Okay. So there is a limited partner who is providing capital. Okay. General partner will also contribute, but very small amount. Okay. These are fund managers. Okay. And they will do investment management also. That means they will make sure that how this fund is getting invested in the market. Okay. And everything is happening through this LLP. It can be hedge fund, it can be private limited, private equity fund. That is a partnership firm. Okay. Who are the partners? Limited partners and general partners. This is very important. Huh? Next, this LLP will invest into the market. That means they will buy and they will invest into some tech company. They will invest into some pharma company. Right. So these are portfolio companies. So if you look at SoftBank, okay, it is also a private equity fund which is investing in Ola, Paytm, right? This is the basic structure. I hope everybody is able to connect to the diagram. Okay, what is the basic structure? There is a general partner, there is a limited partner. Okay, look at this line. They have unlimited liability. Okay, why? Because they are managing the business. If tomorrow anything goes wrong, okay, they would not only lose their money, but they would also lose their reputation, because the fund managers, you have given money to fund manager, is not able to perform. Nobody else in the market will give in the future. Okay. Next, they also invest their own money. They could lose, and they're most of the time it's a big chunk of their own private wealth. Okay. But whoever is a limited investor, okay, he is basically investing a portion of money into that fund. If suppose that fund goes zero, he's only losing that much amount of money. Okay, so general partners will take a higher amount of risk, okay, because they're contributing very less. Think of general partner as somebody who is leveraging on somebody else's capital. Okay, somebody else's capital. Partnerships are not taxed at an entity level, so they are taxed at what is happening, okay, in the business. And then when the partnership is paying out to the partner, because you will get some percentages, right? The money will flow back to the partner. When that money is going back to the partner is paid. So partner has to pay a tax. Okay. So profit and loss pass through the individual partner, and each partner, depending upon which country he is into, which tax slab he is falling into, he will have to pay that tax. So it is not the responsibility of the firm to pay tax on behalf of the partner. It is the responsibility of the partner. Now, why are we doing it? Because we want to avoid double taxation. I am also paying tax, the partner is also going to pay tax in his own country. It is going to be complicated. So to avoid double taxation, it is either happening at the firm level or either happening at the firm, partner level. Most of the time it's at the partner level. I'm going to take a pause answering to the query. Okay, Abhishek, answering to your query, do fund managers typically charge higher management incentive fee for separately managed account compared to pooled? Yes. So it is like PMS. The charges are slightly high because they are providing you a specialized service, okay, and they are creating a portfolio as per your requirement. So that is correct. Vibha, answering to your query, do large VC funds like Axel work this way too? So the structure more or less is going to be this. There's going to be some set of investors who are going to be putting the money and somebody else who's managing the money. So limited partner, general partner. Is there a limit on the capital a GP can invest? Generally not, but what they do is they specify the minimum amount of capital that you being a general partner, you have to invest this much minimum. Is this tax treatment globally followed or depends on each jurisdiction? Shubham, answering to your query, so if suppose there is a fund, okay, and one investor is from India, one is from US, so both of them will pay taxes differently depending upon their requirement in their own market of what is the residency that they have. If I am a resident of Dubai, I might not pay any tax, correct? So it is happening at that country level, at that individual partner level. Now, master limited partnership, okay? So these are generally, think of it as similar to GP and LP, similar to that, but it is publicly traded on an exchange. Okay, so all the investors, it is listed on exchange, so I can buy. When I can buy, the fund is going into that, the money is going into that fund. Then there is a manager who is managing that fund, and you can actively see what is happening with that fund. So you can calculate the NAV, and that NAV will fluctuate up and down, net asset value. Okay, so it gives a liquidity advantage. How come? Suppose if you go to hedge fund and I've invested 20 crores of my fund, it is very difficult to get that 20 crore immediately if tomorrow I want to exit. Okay, because if I go to the hedge fund and say that, oh, give me back my 20 crore, they will say there is a lock-in period. You cannot come ask money for the next 10 years, 15 years, whatever that lock-in period is, 5 years. If I want to sell my stake to somebody else, most of the time it is happening at a discount. Okay, now over here, because it is listed on the exchange, the price is easily available and I can easily sell it to some other investor. It is simple as stock buying and selling, right? So it gives huge amount of liquidity for people, okay, who want to enter and exit very fast. Okay, tax efficiency. Now this is not applicable to all the structures, all the master limited structure, okay, but in most jurisdiction, they get similar tax benefit as the private limited partnerships. Okay, the interesting part is this: they can invest into rare strategies or rare asset, okay, like energy, natural resources, also oil, gold, all of this, and infrastructure sectors also. Okay, so very simply, it's nothing but listed on an exchange. So when you're buying it, you're investing into that fund. Okay, it can be small portions, and there is a fund manager who's going to invest that money into the market. Okay, taking a quick pause. Any query, any confusion till this buy side reference? Any query, any confusion? Can an investor sell their stake at any point in time? If it is listed, it is easy, the way you buy and sell stock. But if it is not listed anywhere, then it is going to be tough. I don't think so. They are traded on an Indian market. Globally, they are very common. I have answered all the queries. Rahul, Rohit, Shubham. Let us move forward. Sell side analysts, sell side institutions. Okay, they basically help trade investors to trade in the market. How do they help? See the pointers. Investment research. This is a very, very big chunk. Huh? That means there are advisors who are sitting in brokerage houses, okay, who help customers to take a position in the market. Okay, so if I am a LIC, I have huge cash available and I want to invest, I might have 5-6 brokers with me. I will ask their reports. What is their view about the market for certain stocks? and I might use my own internal team to take a decision on what I'm going to buy and what I'm going to sell. Trade execution. Now this is very, very important. Okay. Trade execution is more of a challenge, because what happens is you cannot direct all your transactions happening to one broker only. Okay. For example, if you're a mutual fund in India, now there are regulations. If you want to do transaction in the market, you need to do that to multiple brokers. You have to split and do the transactions. Okay. So trade execution means there is a broker who's going to facilitate you. There's a platform through which the transaction will happen. So most of the time, institutional investor will call up that broker. Somebody at the institutional investor will call up. He will give the information: buy 10,000 shares of Reliance, 10,000 shares of Apple. Okay, the trader at the broker side, or somebody who's going to execute it on his behalf, and his responsibility is to execute it faster at a very good rate. Okay, at very good price. Okay, what are the cons of master limited partnership? It's a kind of pooled only. It is not a single investment which SMA would provide. So if you're okay with that, and if you're okay with smaller ticket size, you can invest. But every investor does not have the same thought process, right, Prachi? Okay, if you're going to say Mukesh Ambani that invest into mutual fund, he will laugh. He will say, I'll buy the mutual fund company, right? So they have a very different strategy because they want to play the game at a very different level. Okay, interesting. Next point. I hope I've answered the query. Market making. Okay, I want everybody to focus over here. What is market making? So, suppose there is company A. Okay, he wants to take position on a bond. Okay, investor A feels that the interest rate will go up, and when the interest rate goes up, what happens to the bond price? Bond price will go down. So what he will do? He will sell that bond. Okay, he will borrow that bond from his broker, and he want to sell it in the market. Okay, now there could be a bank who is basically buying it. Okay, please look at this transaction. He is a seller and he is a buyer. Okay, so he is paying that dollar and he is getting that asset. Now a bank, what he is thinking, I'll buy this asset and I will immediately find some other buyer in the market. Okay, so bank will sit in between. Suppose there is company C who wants that particular bond only. Okay, so bank will purchase that asset and will wait for somebody else to come on the other side, and he will sell that asset and collect dollar. So do you realize, for a bank, he is actually going to make very small portion on this transaction. For example, he has purchased at 100. Okay, now when he's selling, he's selling at 102. But do you realize he's not taking very high amount of risk over here, because he's buying from here and selling it to somebody else. Okay, the only risk that he's facing, I have purchased, but there's no buyer available. Then there is a risk. If there is a crisis in the market, nobody's going to buy. I will end up being with an asset, okay, and the prices are going down. Okay, so this is an example of market making. Okay, market making in simple terms means I am providing liquidity in the market, because whenever the seller wanted to sell, I am ready to become the buyer, right? Whenever somebody wanted to buy, I am ready to become the seller. That is market making. Okay, facilitates smooth transaction in the financial market. Okay, facilitates smooth transaction. Now these sell sides, they, like I said, facilitating, that means they will not invest their own money, but they will make sure that the trader or the investor is able to invest properly, and they will earn money in between. Say for example, if I'm giving investment research, I will charge the customer. If I'm facilitating somebody with trade execution, I will charge some commission, some brokerage, right? In the market making part, I'm going to make that 2 rupees difference, 100 and 102, right? So there's going to be some commission, some spread, something which I'm going to charge to the customer to generate return. Okay. Dealers are generally used for market makers. Okay. Dealers are generally used for market maker. I'll give you one more connecting point of dealer. Suppose this is a dealer and you are sitting here in front of him on a table. Okay. and you're talking about a currency, okay, USD INR, okay, current rate in the market is say 75, okay, and you are thinking to, when you go to the dealer will give you two prices, bid price and ask price. Okay, I'm just taking this as an hypothetical example. Huh? So suppose this is 76 and this is 74. Generally, this is not, this much difference is not there. Okay, now if you want to buy USD from the dealer, you will have to pay 76. Okay, so you are buying means plus, huh? He is selling. And if the same USD you want to buy, sorry, you want to sell, okay, then you will only get 74 rupees. Suppose you already have USD, you want to sell, he will only give you 74 rupees. So you are selling, he is buying. Whatever is the difference, that difference is the bid ask spread, which is the profit of the dealer. He's facilitating the transaction, okay, and because he's also taking the risk in the market, that is why he's basically charging a spread. I'm taking a pause. Any confusion, any query till this point? I hope everybody is good. Let me go back to this. Okay, large dealer banks are generally big investment banks, okay, who are there in the market to facilitate. Okay, JP Morgan, Morgan Stanley, all of them. Okay, they have a market making activity happening. Okay, retail brokers, okay, stock brokers for smaller individuals like you have Sher Khan, Zerodha, okay, all of these participants. Okay, most active is the large dealer bank. They are available in multiple assets, so they are not doing market making only for currency, for bonds also, for different types of stocks also. Okay, large dealer banks, let us go into the detail. Okay, large financial institution, now you can look at it from the two market perspective. Okay, primary market and secondary market. Now this is very, very basic. If you look at primary market, it is nothing but when the company or the issuer, okay, is going to the market for the first time. Okay, so when Zomato was supposed to go and issue an IPO, that means I'm going to sell this share to the market to generate capital. I'm doing it for the first time. Okay, so over here a financial institution like JP Morgan or all of this or investment banks will help me do that. So IPO is one way where the company Zomato is directly interacting with the investor. Similarly, I can issue bond also. So when I'm first time issuing a bond, first time in the sense any bond I'm issuing first time, okay, that is also kind of an primary market transaction. Once this asset is sold, suppose I have sold a bond, now I have got the money, okay, I am gone. So Zomato has sold the bonds to the public, to the investors. Zomato received the money and he's gone. Now the investors, if they want to sell the bonds to somebody else, that will happen in a secondary market, because now the transaction is only happening between the investors or the traders. There's no transaction happening with Zomato. Okay, there's no transaction happening with Zomato. Okay, so dealer banks or investment banks help in underwriting and distribution of new securities. Whenever there's an IPO, you need an investment bank sitting in between trying to understand what should be the price of this company. They also need banks to sell it to big institutional investors. So they generally do roadshow, okay, where they will call mutual fund guys and all of them. They will highlight that what is this company all doing, and they try to sell their securities in bulk to these kind of institutional investors. Okay, so underwriting and distribution, okay, actually conducting that IPO, that is also the responsibility of big financial institutions because they act in between. Okay, next is act as a middleman between the issuer and investor during IPO and bond issuance. In most cases, bond issuance, they also do like this. If there is an issuance, okay, there is an issuer, suppose DMart wants to come out with a bond, okay, and if the bond issue is very small and the bank is decently big, he can buy the entire bond and then he can sell it to the normal public. So DMart will by default get X amount of rupees. The bank has negotiated the price and then he's selling it in the market in the future. Okay. So if you look at Zomato, Kotak Mahindra Bank and Morgan Stanley, they acted as an underwriter over here. This was the primary market. Okay. Look at secondary market where the transaction is happening, okay, not with the original company. So if I'm selling, if you're talking about Zomato shares, okay, so me and you are buying and selling. There is no transaction happening with the original issuer. Okay. Or else I can do a transaction with some bank, but I'm not doing transaction with Zomato. That is your secondary market. That is your secondary market. Okay. Over here, market making will also happen because suppose there is a company, okay, a private limited company, for example, but well-known company. You are an investor and you want to sell. Okay. So what you can do is you can directly go to a dealer and ask him for a price, and you can directly sell those shares to him, and then he can sell it in the future as he wants. Okay. So generally you will find large institutional investors, broker dealers, they're sitting in this market to provide liquidity. Okay. There's one interesting concept, engage in proprietary trading. Okay. Now for banks, global banks, this has been stopped after the Volcker rule. Okay. What is proprietary trading? Any company has their own funds available. They can use that fund to invest into the market. But the problem that was happening, they were speculating a lot. And because of that, the risk was increasing. So banks, apart from the customer money, they also have their own profits. So they can invest that into market, right? So proprietary trading is nothing but using banks' own money to buy and sell securities. But the trend was that it was being used for speculation, which was increasing the overall risk. I'm taking one small pause over here. Let me know if there is any confusion. Difference between a master limited partnership and stockbroker. They are very different. Master limited partnership, you can think of it as something listed on NSE. You can buy and sell. Okay. What is a stockbroker? Stockbroker is helping me to buy and sell on the NSE. So like Zerodha. Okay. Kindly read till this point, everybody. I hope everybody is good. Now, what do large dealer banks actually do? Okay, they do market making. We have already talked about this, right? They do proprietary trading, which basically is nothing but own bank's money. That is nothing but on their house account, not on customer's account. So they will take positions in the market. Suppose the bank feels that the currency rate is going to go up from INR, USD INR 75 to go to 80, 90. So I'll buy a lot of USD and I'll wait. Okay, that is proprietary trading. OTC transaction, that means it is not happening on an exchange. It is not happening on an exchange. It is a transaction happening over a call. Everything is recorded. So JP Morgan is doing a transaction with Citibank. Okay. So on both the side, the traders are there. They are executing the transaction. And generally OTC transactions are slightly different or unique transaction. For example, if JP Morgan wants to buy oil barrels, okay, of Brent crude oil, and they want to buy 1111 barrels exactly, and they want this barrel of oil exactly after 3 months, okay, on 17th of February on this date exact. This is customization. This can only happen on an exchange. It can only happen on a OTC market, which is a transaction between you and me, where both the parties agree, they negotiate, and they customize the transaction and then execute the transaction. Very simple example of this is swap. The way you have futures, options. In the derivative section, we'll be covering that. Futures, option, we also have swaps. Okay. Off balance sheet financing. Okay. It is more like the overall structure is that I'm not going to take loan. I will have one more entity which is supported by me. That is going to take loan in the market. That is going to raise money in the market. So if you remember, we talked about this. Citibank in the previous chapter, and Citibank is creating a special purpose vehicle, right? and that special purpose vehicle is holding a pool of home loans. It can be any asset. I have taken an example of home loans. Okay, now the special purpose vehicle is selling that structured product MBS in the market, okay, to the investor. This is an example of a structured product, okay, or securitization. Now, this Citibank is legally different. This special purpose is legally different. So when investors are buying, they have been told that this special purpose is bankruptcy remote entity. That means if tomorrow there is a bankruptcy to Citibank, your investment is safe, your MBS is safe. Why? Because special purpose vehicle, or say Citibank NG India Advantage Limited. This company is different. Okay, so you have good amount of protection. The risk is reduced. Okay, there is no financial risk. If tomorrow Citibank collapse, there is no financial risk. So what we do, okay, we create off balance sheet entities like special purpose vehicle to do certain transaction which I do not want to do on my own books. Okay, because if I bring it on my own books, the risk is very high. So you raise money through them, you sell asset through them. Okay, I'm taking one more small pause. Any query, any confusion? I hope everybody is doing good. Let us move forward. Okay, large dealer banks, okay, how they're different from a traditional bank. Traditional banks, when you open up an account, you can accept deposits, you can get normal loans. They also give corporate loans, right? But when you look at the big banks, okay, large banks, they not only do traditional activities, they also enter into other activities. They have investment banking arms also. Okay, so they also offer prime brokerage services. What is prime brokerage services? The way you have broker for you, Zerodha. Similarly, these are broking services for hedge funds. Now, hedge fund might need huge leverage. Okay, suppose a hedge fund wants to buy 50,000 shares of Apple, but they want to only invest $10,000. Example. So remaining is funded by that prime broker. Okay, he's facilitating the trade. Okay, so over here, generally big companies, big financial institutions, they provide prime brokerage services because the transaction which an hedge fund will do is also very big. Okay, few of the examples of large dealer banks. This is just for reference that we have added. Okay, so these dealer banks not only do traditional banking, but they also enter into unique services like prime brokerage services. Okay. Answering to your query, Rahul, if SPV portfolio goes bust, is Citibank liable to fulfill obligation? Now, in some cases, going back to the Citibank example, Citibank might provide funding to special purpose vehicle if there is a stress in the market, depending upon what is written in the contract. In normal cases, it is not. There is no risk. Okay. Providing line of credit is a part of prime brokerage services. Yes. So if you look at Lehman and JP Morgan was providing services to Lehman. Okay, line of credit. Who are retail brokers? People who help you and me to do a transaction on the market. Zerodha, Sher Khan, IIFL. Okay, they will charge you a commission. Correct? They help you to execute the transaction. That means execute the order in the market. Okay, they provide investment research. Obviously, these are not niche researches. These are generic research which is available with everybody. Okay, they give recommendation to their customers, right? But there are certain services where you have to pay. Breaking up large trades, that means if I want to buy 1 lakh shares of a particular company, if I directly go and buy, the price might jump. So they will provide me with a facility that my transaction will happen in chunks or basically pieces so that it does not impact the price. Okay. In some cases, taking the opposite position. Okay. Buying when the client sell and selling when the client buy so that they can close it later. It is similar to a market making. Somebody is there, he's coming to sell, I'll buy and I'll wait and I'll sell it later. That is basically done by some of the brokers. Retail brokerage firm, what are the divisions? Okay, front office, middle office. Front office is where you have a trader. He is talking to the client and he's basically asking client is giving him information that you have to do transaction like this, you have to buy this asset at this quantity and this should be the price. Okay, so a lot of client interaction and trading decision happening over here. A lot of mistakes can also happen. So client has said buy 10,000, instead of that you purchased only 1,000, right? So they meet clients, they open up the account also. Okay, then they also suggest that this is a new stock which is going up. If you go and call up your broker in Sher Khan and all of that, he will give you n number of information. There is a tip for this stock, buy and all, right? And he will execute the transaction. If you're calling him and saying that buy this stock, he will execute and he will give you the confirmation. Okay, middle office is very interesting because whatever transaction is happening, there could be a risk, right? So the risk management is done in the middle office. Suppose the client called, okay, and client has asked him to buy something. Everything is recorded. Okay, so later on, risk management can, on a sample basis, can look at that recording and see whether the trader has done exactly the same activity or same thing which the client was highlighting. Correct? So there's a lot of risk management happens. Suppose if I'm giving a margin to some clients, that means client can invest small amount and broker will fund the other. Suppose you want to buy stock of $10,000, you only have 2,000, 8,000 is given by the broker. That is basically buying stock on margin. When you're doing that, okay, there is a risk team who's going to decide which customer should get higher margin, which customer should get lower margin. Then you also have a lot of compliance because you're doing transaction on NSE and BSE. There is regulatory compliance also. There's a lot of back office activity that is going to happen. Okay, regulator in India is SEBI, so they have rules and regulations that you have to follow. So that generally happens in middle office. Okay, then there is back office also, which is more of accounting entry. If the customer has purchased something, he'll get an email with the transaction. Okay, if he has any queries, he can call up the back office and ask for some statement and all of that. Okay, so it's purely support and admin happening at the back end. Okay, few of the examples of retail brokers, you must have heard their name. Okay, I'm taking a pause. Any query till this point? Rahul, answering to your query. Does transaction where broker taking opposite side of client trade gets executed offline, or can this take place online? Online also is possible, but it all depends upon market to market. Okay, all depends upon market to market. I'm going to take a pause. Any query till this point? Right? So we have completed buy side, we have completed sell side. Now there are certain other providers who are also there who's helping you, okay, in doing the entire activity of trading. Okay, so there are outside service providers who also play very critical role, okay, because they might help you to complete the operations, they might help you to do the compliance, that means regulatory requirements, okay, and also financial management, how your money is managed. So generally you have custodian banks, okay, or custodians where my securities are stored, my cash is stored, because I'm very big. I'm LIC, I have so many shares available, I have purchased so many stocks, okay, who is the custodian who is managing it? So many assets, so many money, right? So that is also possible. If there's no custodian, then it is going to be difficult for me to manage that much amount of asset, right? So he is just one example, okay, who will help you to do the entire functioning smoothly. Now think about hedge fund. They also need these services. They need risk management services, okay, they need prime brokerage services, they need custodian, they need agent banks sitting in between, okay. So all of them, these service providers will help you to do the transaction smoothly in the market. Prime broker, like I said, very simple, a broker for a hedge fund, okay, a broker for an hedge fund. What all services he provide? If the hedge fund says I want to buy XX amount, he will help you to do the transaction, trade execution. Lending securities for short selling. Why? So if today in the Indian market on exchange, if I want to sell something, do a short selling. Short selling is I'm selling first and buying later. But how can I sell something which I have not purchased? there's a broker who's going to provide you with that. Okay, broker will lend you that security. Now similarly, a prime broker will have a pool of securities with them. Now I can lend this security to my hedge fund customer. He can take short position in the market. Okay, so I can provide security to him, plus I can provide funds also. Okay, for example, Lehman Brothers during the daytime, okay, they need $20 billion of funding, and evening they will return that $20 billion. Okay, so that kind of services are also provided. That means financing is also provided so that these hedge funds can take high risky bets. That means they will not invest their own money, they will invest the broker's money. Okay, next is management, reporting, research, that is there. Margin call management is also important. When does a margin call come? Very simple example is, if I have purchased something and the price start going down, okay, so the broker will call me, put money into the margin account, or else we'll have to sell this out. You cannot hold it. Okay, so whenever you do transaction in Indian market on intraday, you get leverage. Suppose I have invested 5,000 in my margin account, I can trade up to 20,000. Okay, so if tomorrow I have purchased up to 20,000 by investing 5,000, if the price goes down, the margin account will go down and the broker will call you that put money or sell securities. That is margin call management. Okay, put extra money, that means put more collateral, or I'll sell the security. Okay, these are the primary activities done by the broker, prime broker. Okay, next is auditors and accountant. Okay, this is a very basic service which is being provided to almost all companies. Okay, what is this? During fund setup, obviously if I'm going to create a hedge fund, I'm getting investors on board. Okay, it has to be done properly. So there's going to be an auditor, accountant, lawyer, right? So that the entire structure is legally correct and there is no tax implication. Next is, if there is a fund being created, hedge fund or private equity fund, it has to be audited by some third party so that there is no misuse of money done by the fund manager and the team. Next is tax compliance. So you might get KPMG to do a tax audit or do some tax filing, right? Performance evaluation is also there. So you might ask an external consultant to see that how the assets are getting purchased. Very, very important part is asset valuation, because your entire NAV and all, everything, every reporting that is happening is based on the valuation of the asset. Now think about this. If I have purchased an asset which is not listed, okay, then suppose I purchase some commodity, I will have to calculate the price of that commodity to determine what is the current value. Okay, but suppose if I made a mistake, okay, in that calculation, the wrong picture will go to you as an investor. Second, if I want to hedge, I will do wrong hedging. So everything will fall flat. So over here, risk management, your reporting, everything will get impacted. Asset valuation. Okay, there's a famous case of London Wales, okay, where the trader, or basically the investment officer, he was fudging with the numbers of valuation. Okay, and that created a very different scenario. Everything was in profit, but in reality it was in loss. Okay, so you can hire Deloitte or any other agencies, okay, who is going to do the filing and auditing and activity. Okay, any query till this point, guys? Is the asset valuation done by third party or in-house? Generally it is done in-house, but if there is, these activities are audited. So you might ask some auditor to come or consultant to come and check the accuracy of the valuation approach. I hope everybody is good. Can I get a quick confirmation? Right? Attorney, this is nothing but the legal, because you are having a legal documentation, right? So when you're going to create the fund, you have to make sure that all the limited partners, all the general partners, they're signing, right? When you're going to invest the money into, say, Ola, and you're going to buy the stake, there is a legal team involved, right? So fund formation, at that point also the attorneys are needed. If I want to do some regulatory requirement, legal team will help me out. If I want to make an investment contract, like I said, I'm going to buy some stakes in Ola. Okay, so I will have to make sure that the investing contract happens properly. Okay, next is marketing and investors relationship. That, because generally you have investors relationship corner in your website, where whoever has invested money into your account, that investor can send you an email or talk to you. Every big company has that. Okay, So legal team is also helping there, that what should be the response. If an investor is asking X amount of queries, what should be your answer? Right? And if suppose I have investors who are from international market, legal framework becomes more important, because then in that case, how the money will be transferred, what is the tax implication, what is the legal requirement, all of this will become very, very important. Okay, so you have attorney also, then you have fund administrator. Now think of it as a back office activity, because it is like this. Now you have purchased a stock on an exchange, now everything is automated, but you get a message, then you get a statement, right? And it tells you that what was there in your margin account, now how much is there, how many new shares you have purchased, all of this. Okay, if you go to your retail portfolio, for example, Zero the account, Kite, you will see that they're showing you a dashboard with respect to where you have invested, what is the performance, so tracking performance. Then investor report, you can download the report and see when you have done transaction, right? Verifying asset and calculating fees. Fees over here is nothing but how much money, okay, the fund manager should get, how much money the investor should get. That also, basically entire bookkeeping. Okay, and whenever there is audit or a regulatory requirement, you have to provide support. So these are general activity which is done by accounting teams within the organization. It is the same happening over here. So hedge fund has outsourced this activity, for example, to KPMG. So they will take care of the reporting, filing, and all of this. Okay, and also the SEBI regulation. I'm going to take a quick pause. Any queries, any confusion till this point? I hope everybody is doing good. Let us move forward. Now you also need technology support, you also need data services support. Okay, three key components of an hedge fund infrastructure. Okay, you need financial platform, okay, where the transactions can happen, where the portfolios can be managed, right? So you generally have financial platform, software, and the data provider. Data provider means, suppose if I want to do valuation, okay, so I can take data from Bloomberg and do the valuation accordingly. I need historical data. Okay, I can go to NSE website and download, right? So I need somebody who can provide me with data, because I have to run models. Okay, so to run the model, I need data of securities pricing, market pricing. Okay, so all of these three are infrastructure that is needed by any hedge fund to run in the market. Over here, look at the example. Okay, they take data from Bloomberg, okay, real-time data. They use that data and run a model. Model can be on Python or MATLAB, and this will give them a strategy that what should be my portfolio's next buy, or which asset I should buy. Okay, so you need technological support also in the overall part. They are also outside providers, okay, IT companies. Next is consultant. Now this is applicable to retail investors. This is applicable to ultra high net worth individuals or family offices, right? The way you have your own consultant for your tax consultant or your chartered accountant, right? So they are expert who is managing the investment decisions, right? So they allocate portfolio money. Okay, they look at what is the overall portfolio allocation, how much should go into real estate, how much should go into stock, bond, mutual fund, that way. Okay, over here they look at ongoing monitoring. They also check whether the fund manager is actually performing properly or not. Suppose I've invested into a mutual fund of Franklin and that fund is not doing good, so the consultant can ask me to remove money from that fund and invest it somewhere else. Okay, compensation method. I'm going to take one more quick short pause. Any query, any confusion till this point? Consultant. I hope everybody is good. Compensation for the consultant. Now this is slightly basic. I do not expect this to be tested in the exam as such. Okay, fee based like the way you hire any doctor or consultant, right? Hourly or a fixed cost. Commission based is based on the performance. So for example, if I'm entering into portfolio management services, one of the ways you can compensate them is you can say if I earn above a certain level, then you will be able to, I'll give certain percentage of my income or percentage of the growth. So if you are able to generate more than 10% in Indian market, whatever is the growth, you will get 30% of that. So when I make money, you make money. That is also possible, right? Managing fund of fund. Okay, over here you have a management fee and a performance fee. This is, I hope remember, 2 plus 20%. 2% is a management fee, 20% is the performance fee. If there is a benefit, this 20% is incentive. If the fund is able to perform above a certain level, then the growth will have 20%. Okay, so it's a combination of the first and the second. Okay, we've given you an example also. You can read till this point. Depositories and custodians. Okay, now depositories are somebody who is holding the securities. Now whenever you normally do transaction in the market, I'm talking about stock exchange. Okay, whenever you normally do transaction, okay, so there is an exchange over here, then there is clearing house, okay, who is sitting. Whenever the transaction happens, this A and B, okay, the exchange will give an information to the depository participant. On both the side. Okay, there is going to be a depository participant. Okay, and they will pass on the information to depository, like NSDL, right? NSDL. So what will this depository do? Suppose there is a buyer, okay, and there is a seller. So what is happening? I'm just giving a very simple example, a basic. From the buyer's account, money will be debited, okay, and from the seller's demat account, the asset will be debited. Okay, that will move from the broker, okay, to the depository participant. It will go to the depository, and this depository will take money from the buyer, pass it on to the other side, take asset from this side and pass it on to the buyer. Okay, so money will go on this side, asset will go on this side. Now this is not happening for one transaction. On an exchange, ideally the depository participant will upload an Excel. It will have so many transactions, or basically it will happen automatically. Okay, but it will be in the queue. Okay, and that is why you have T+1, T+2 settlement cycle. So today, if the transaction has happened, okay, suppose if it is T+2, within the next 2 days, okay, the money should come to the depository, okay, from the buyer's account, and asset should come from the seller's account, and then the depository will transfer. So they have cutoff times. Okay, before this cutoff time, money and the asset should come, then only the settlement will happen. I hope everybody is good. सब है साथ में? Okay. So, depository will store and protect security. What if either party will default? There is a clearing house, Shubham. Clearing house already has taken margin money from you. Okay. So it is a responsibility of the clearing house that the transaction will get completed. They are charging you clearing fees. Okay. So they hold client assets securely. They clear and settle trade. Like I said, they will make sure that the money and the asset moves. Okay. And they will give confirmation on the trade that yes, the settlement has been completed. Okay. Very simple example, famous example is NSDL. You also have CDSL. Okay. But I explicitly mentioned NSDL. Then you have depository trust company. Okay. US based depository who's managing all the different types of transaction, and everything happens on an electronic platform, because your shares are in your demat account. Okay. And then you have margin, which is in your trading account. So those two accounts are used to do the transaction. I'm giving you the example of the exchange. Okay. I'm giving the example of exchange. Banks. Now banks are very important player. Okay, if I'm an investor, okay, and think of it like this: if I'm JP Morgan and I want to do it, I have done a transaction in which I'm supposed to pay JPY, Japanese yen. I do not have JPY, so I will have an agent bank with whom I have a relationship, and he can immediately provide me JPY, and I'll give him US dollar, and the transaction will get completed. Okay, so banks provide very, very important services over here. They provide loans, they provide line of credit. Line of credits are taken explicitly by companies. Okay, they have open line of credit available. Tomorrow immediately you can go and withdraw. So line of credit is nothing but a contract between you, a company, and a bank. Okay, and for a fees, bank is going to say that, okay, you have 10 crore rupees line of credit. Any point in time you can go and withdraw that 10 crore. Now there are variations, revolving line of credit and all of that. Okay, but the basic concept is it's a loan, but it's a pre-approved loan. Okay, they offer depository account for fund managers, because they can also, because money also has to move out. So from that fund manager's account, the money will be debited, and that will go to the NSDL. Okay, they also assist in capital management. This is generally called cash management services. So cash is available with the fund manager, and he wants to invest that cash for few hours overnight. That service is also provided by the banks. Okay, investment banks, they do IPO, bond issuance, underwriting basically. Then they also advise on merger and acquisition. They also provide corporate advisory. Suppose you want to do restructuring in your company, you want to sell a spin-off and take one business, say for example ITC, they have multiple businesses. They want to break it everything into individual company. Investment banking will help. Investment bankers will help. Merger and acquisition, Kotak is buying ING Vaishya. Investment banker is involved, right? They also provide trading and sales. So all the leading investment banks, they have trading and sales team also. This is the front office, where a customer, for example, Axis Mutual Fund, can call up Morgan Stanley trading desk, okay, and say that I want to buy this amount of security. So he will buy on the customer's behalf. Okay, trading and settlement, where the transactions are happened for the customer. Okay, I hope everybody is with me. Is trade settlement done by custodian? No, custodian has securities available. Now think of LIC. LIC has lot of assets, and there are 10 custodians available. So whenever LIC's trader is going to inform the broker that I want to do this trade, okay, and you have to get the securities from custodian number 4, because that security is sitting with him. So you have to, in the transaction details, you have to tell which custodian to hit for the asset. Correct, Abhishek? Any query? All good. Can you please elaborate a bit on unlimited liability of general partners? So you have to think it like this: if anything happens back to the fund, who is going to have unlimited risk? Who will have to pay ultimately? That is the general partner. They might lose their entire net worth. That can also happen if the loss is too big. Now over here, they've given you some regulations. Now this section is not important, okay, because very difficult for you to remember on the actual exam day. Okay, but few important points, like for example, this universal bank, that in India, you'll find commercial bank different and investment bank different. Okay, US also, commercial bank is different. Morgan Stanley, who's providing loans, who's providing saving account, checking account, is different as compared to an investment bank. But in Germany, it is combined. Now, generally we keep it separate because the risk of investment bank is very high. Okay, so the way banking is managed in Germany is slightly different, universal banking. So that is one thing that you can remember. Okay, German firms use two-tier boards. What is two-tier boards? In India, when there is a company, for example, Reliance, they have only one board. Okay, there's one chairman and all. But in a lot of global companies, they have two-tier. One is the management board, one is only supervisory. That means the supervisory board is basically checking, okay, that whether the management board, who is actually running the company, is running it properly or not. Okay, one for handling, one for overseeing. This is a very famous structure, two-tier. Okay, mark this as star. Next, UK. Okay, they have clearing banks, they have merchant banks. Merchant banks are nothing but investment banks. okay, who provide investment services. Okay, if you want, say, letter of credit, merchant bank can provide. Okay, if you want to do bill discounting, merchant bank can provide. Okay, commercial banks generally will give you current account, basic line of credit, loans, like that. Okay, Germany and UK, Japan. Large corporations are linked through cross holding. Cross holding means this is generally there in Japanese culture because they want to make sure that whatever big companies that they had, they should not fall. It is also there in shipping in Japanese. So one company, shipping company, will buy a stake in other competitor if they need money. They will buy the stake. So there are interlinkages of holdings. Okay, so for example, you will have Nomura or Mitsubishi, okay, or Sumitomo. They might have stakes within them, across them. Okay, so this is cross ownership model. Okay, well, bank owns majority of stakes in different companies. Okay, so what happens when they are holding stakes in different companies? If there is a decision has to be made, bank can have a good influence. They can vote against it. Okay, Mitsubishi Bank, very big bank, one of the global banks. Okay, they own shares in top companies, making sure that there is a financial stability. That tomorrow, see, one of the biggest investor in them is Mitsubishi Bank. If anything bad happens to a company, they can buy more stake and provide liquidity. Okay. Now this is kind of a summary. Okay, buy side, sell side, and all the outside providers. We've already discussed all of them in detail, correct? Any queries, Shubham? Till that time, everybody start reading. So basically, all the Japanese large institutions have share across other large institutions or banks. Mostly banks hold shares of other companies. Mostly. I hope everybody is reading. Chalo, please start reading. Mr. Deshmukh, he is working for Bharat Vista Capital, is advising the Finance Ministry to deploy surplus revenue. The ministry seeks to build a reserve that could be used for economic stabilization and future national need. Very, very important. Which of the following vehicle is most appropriate? Like you guys are highlighting, it's a sovereign wealth fund. Okay, we gave you the example of Abu Dhabi and all of that, right? So answer is B. Look at the next question. Maitri Investments. Sorry. Nikhil Rawat, he handles complex transactions, right? And he handles complex transactions for high net worth clients. Recently, a client placed a large sell order to maintain trade confidentiality. Nikhil executed trade into small parts and temporarily took an opposite size of the trade before gradually exiting the position. What kind of role is he doing? What kind of role is he a prime broker? Because this is a hedge fund? No, it's a high net worth client. So this goes out. Middle office analyst, front office analyst. See, back office is only for settlement, right? Answer is front office trader. Okay. And he is providing all of this support. It is C. Answer is C. Shreya is setting up an alternative investment fund. She hires an external party to handle multi-asset trading across broker-dealer, margin financing, security lending. Okay, research consolidation. Which is the external service provider that she has engaged? Read it properly, please. So the catch is over here, alternative investment fund, which is similar to a hedge fund. So over here, prime brokerage will not only help in execution, but also provide other services. Margin financing, he will fund. We talked about this, right? Next is alternative investment structure. I hope everybody is good till this point. Chalo, we'll move forward. Limited liability and passive investing. What is the concept of limited liability? Have you heard in India, you have either partnership and LLP. LLP. What is partnership? Partnership firm, suppose I and Rahul become a partner. Normal partnership firm, there is unlimited liability. If I did any fraud, he will have to pay. But if it's a limited liability partnership, my liability is only limited to the percentage of shares that I have purchased. Okay, so liability becomes limited. Investor knows what is the maximum amount of loss I'll have to face if anything goes bad. This is very, very important to protect. Okay, this is very, very important to protect as an investor. Okay, that is why we generally go into the limited liability structure. Okay, what is active and passive? We have already talked about this in the first chapter, right? What is passive investing? You're basically mimicking benchmark, trying to create a portfolio in such a way that you earn what is earned in the market. Okay, so if I'm going to mimic NSE's Nifty, I'll create a portfolio which is exactly matching the Nifty. So if Nifty makes 10%, I'll also make 10%. Correct? So I'm trying to mimic the market performance. What is this? Passive investors benefit from limited liability because they have no direct control over the business operation. That means if I am an investor and I want to do passive investing, what I can do, I can create a limited liability partnership. I can have a fund manager. I can invest the capital. Okay. Now over here, because see, I'm not looking at where the fund is actually getting invested or how it is getting invested. So I might not have the visibility. So to protect myself, I can have limited liability structure in such a way that if anything happens bad, I'm still know what is my maximum amount of loss. Look at the example. Okay. If you invest 1 lakh in hedge fund and the fund collapse, the maximum loss is only 1 lakh because you were not, even though the fund is getting actively managed, in this case, it is the fund manager or the general partner who is going to face that unlimited risk. You will not face that unlimited risk. Okay. So if you remember limited liability and limited partner and general partner, we talked about that, right? From the word limited partner, it means my risk is limited. General partner is involved in the activity of the business. He has unlimited risk. Okay. He has unlimited risk. I hope everybody is good. Why is limited liability important? Because as an investor, if you know that you can create a structure where the risk is low, you will enter. So more and more people will enter. More and more money will come, right? More investors will come. And then it becomes easy for the investor to not have much burden, much risk, and thinking about that risk, he will go out, right? So protects individual from excessive financial burden. Very simple, limited liability, importance. Ethical concerns. Now, this part, probity. Okay. Since investors enjoy unlimited profit potential, why? See, if the fund does very well, it was my money it was invested. I will be earning huge money, huge profit, but the risk is limited. So there can be chances of taking excessive amount of risk, or there could be corporate governance issues with respect to fairness and accountability. That means they may not think about the overall market. Okay, they might take excessive risk only thinking about their upside potential, not thinking that they are doing something wrong in the market. Okay, so from that perspective, this concept is there. I'm going to take a quick pause, read till this point. Everybody. Let us move forward. So limited liability companies versus corporation. Okay. See, whenever you hear the word corporation, now you have to remember this part. It is more structured. Okay. It is more structured in terms of their legal agreements and all of that. Okay. So that word you need to remember. LCC offers flexibility in profit distribution, and some risk can be there if there is a fraud. So look at the structure now. So look at this table. Okay. Corporations who hold shareholders, the way you see any company. Okay. They are corporation because there are shareholders who are owning it. Then you have limited liability company. It is like a partnership firm, but the structure is company. But who is creating that? The partners, the members are creating it. Okay. So the members are limited. But in a corporation, shareholder can be anybody. Okay. If I am a shareholder, what is the maximum risk I'm going to face? Whatever money I had invested in the stock, that is what I'm going to lose. Okay. Now over here, okay, even though it is limited liability, okay, on paper it is limited, but suppose if there is something extraordinary fraud happened, then you will have to highlight that I was not having the knowledge of that. Okay, so there might be litigations against you and you'll have to manage that. Okay, protection is not absolute. Fraud or mismanagement, okay, can make the investor also liable for it. Profits are distributed to shareholding party. If I have purchased 10 shares, I'll get profit accordingly. Okay, profit accordingly. In a lot of countries, there is a tax on distribution of dividend or the profit, basically, because dividend is coming from the profit. Profit can be shared easily, okay, even if ownership stake differ, which means there are certain partners who have 50% ownership, certain partners who have only 10% ownership. But the movement happens very easily. In corporation, there are a lot of regulations that they will have to follow. Okay, there is minority interest concept. Okay, when you are taking decision, you have to think about minority interest. Okay, and then take decision. That is also followed over here. Okay, so TCS is an example of a corporation. Okay, and a symbol private limited firm, okay, is nothing but a limited liability companies, private limited basically. Okay, any confusion till this point, guys? Any confusion, any query till this point? All good. Look at this. Now this is kind of repeat of what we have already seen. Okay, what is a limited partner? Somebody who is coming with the capital. Yeah, I showed you a diagram also, right? So limited partner who comes with a fund, and because he is investing fund, he says if the funds are lost, that is the maximum I am going to lose. Correct? But whoever is a general partner, he is the fund manager. He is running the fund. He, in some cases, he might contribute. Okay, but he has the unlimited liability because he is involved in the day-to-day activity of the fund. Okay. So limited partners like these pension funds, sovereign wealth fund. So these people, they put some amount of money into hedge funds. So they become limited partners. Okay. And then you have firms or fund managers who are managing that fund. Okay. So private equity fund like Blackstone, whoever is the investor who has put the money into Blackstone fund, that particular fund, the fund is managed by Blackstone. Okay. But I am an investor. I have only limited amount of risk. Okay, what is the benefit for me who is a limited partner? The risk is limited. Okay, fund manager, even though they are taking unlimited risk, but they have full control. They can decide where the money is going to get invested. Correct? So that they have more control, more flexibility in decision making, which a limited partner does not have. Okay, it's a private equity fund. No? They have capital available. They're going to invest. That's correct. Buy side. Vibha, which point we are talking about? Think of a listed company and a private limited company. In listed companies, profit are distributed based on how many shares you are holding. Okay, in a private limited company, you are a director with a percentage of ownership, percentage of shares. So you're going to get that much amount of profit accordingly. I hope everybody is good. Limited partner, general partner. Now this concept will keep on repeating. Huh? So from the exam perspective, this concept is very important. What is limited partner doing? What is general partner doing? What is the risk? Also very, very important. Did you remember I used this word, bankruptcy remote entity, Citibank, special purpose vehicle, right? So why am I creating a special purpose vehicle? Because if tomorrow, me being a Citibank, if anything happens to me, okay, your money is protected. You are an investor, you are dealing with a special purpose vehicle, it is protected. Okay. Now these are nothing but different names. Special purpose vehicle, special purpose entity, it's the same thing. Basically, I'm not keeping everything on my Citibank's book. I'm creating one more entity. Okay. And both of us are legally different. Okay. So if a company goes bankrupt, Citibank goes bankrupt. Okay. Special purpose vehicle remains separate. That means whoever is the creditor, they can take, they will have the special purpose vehicle to take care of. Okay. Now this special purpose vehicle, it's a new company. So they can also go to bank, they can raise money, they can issue bond, they can do anything as a normal company does, right? So this helps him to get loan, because Citibank will not take loan on their books. They will create a special purpose entity, they will give the backing and the brand name, and they will raise money through them. If they want to issue bonds, okay, then they will try to issue it to the new company, okay, because they will be able to get a rate which is better. Okay, if they want to take risky bets in the market, they will not do it on their own books, they will do it in the special purpose vehicles entities book also. Mark this as star. This point. Okay, a real estate company creates a special purpose vehicle to own high value properties. If anything happens to the main company, still that entity is there. Okay, protects company against company-wide bankruptcy. Okay, and this is widely used. We talked about securitization, if you remember, that 10,000 home loans pool. Okay, so that is a part of that special purpose vehicle. So if I want to do complicated transactions or securitization, then I will create a new entity. Okay, any confusion, any query on this special purpose vehicle? Right? Tax optimized structures, master feeder funds. Now this is very unique. Okay, master, I've kept few slides also on that. Okay, because in the book they have only mentioned very simple structure, or basically few lines. Okay, investors in different countries face different tax rules, right? So what we can do is, there's a master fund which is going to hold, everybody is going to invest into the master fund. Okay, so this is holding the investment and all the asset. Okay, and when I'm saying everybody is investing into that master fund, how that investing is happening? Okay, so there is a feeder fund, okay, separate fund that invests into that master fund. Okay, so it is like this. There is a master fund which is going to hold portfolio company 1, portfolio company 2, portfolio company 3. There might be feeder fund 1 which is investing into this. There could be feeder fund 2 which is also investing into it. So there are different types of investors, but all the transaction is happening through this master fund. All the assets are managed by this master fund. Okay, over here there might be different set of investors who are investing into this feeder fund 2. Over here there is going to be different set of investors who are going to be investing into the feeder fund 1. Okay, that is the idea. So let us read this. Okay, look at the example also. A US based hedge fund create a master fund in Cayman Island. That means whatever purchasing is going to happen, whatever asset will be managed in Cayman Island. What is Cayman Island? It's a tax haven. Okay, Isle of Man, then you have Mauritius, okay, Panama, then you have Cayman Island. These are all tax havens, right? So over here, whatever assets you're holding, there is no tax that you have to pay, right? But what they have done is, whatever this master fund is going to buy, how the money will come. They have created 2 feeder funds. One is for US investor, one is for European investors. So money is coming from US also, money is coming from European also. Okay. Gift City is not an example of this. This is very different. Gift City is different. Okay. Now this is very, very important, or basically the concept is important for you to remember. Okay, because it helps you to manage the tax appropriately, because every investor is not having a similar requirement of taxes, right? So you can create a feeder fund which matches the requirement of certain types of investor, and through that you can raise money and then put that money into master fund, and that master fund will buy the asset. Okay, so it helps you to avoid double taxation also. As an investor, it is very, very important, because you lose the entire interest, right? You will lose the entire returns that you have generated. Few more points on this master and feeder funds. Again, slight repeat. Look at this. Master fund, this is where the actual investment activity happens. Okay, master fund is getting money from multiple feeder funds. Okay, the master fund does not pay taxes. Why? Because they are registered in the Cayman Island and all, right? So all the investments are happening, money is coming through the feeder fund. Whatever tax or whatever profit and loss that is happening, that is going to the individual feeder fund, and there the investors might pay tax. Okay, all investment gains and losses flow through to the feeder fund. Now, what is this feeder fund? We have already talked about what is this feeder fund. It basically is nothing but money collected from certain investors. So you have created multiple feeder funds from different markets so that you can collect the money in master fund and then do the transactions in the market. Okay, so each investor might have a different tax requirement, so it is done accordingly. Okay, so they've given you an example also. I'm taking one small pause. Any query, any confusion here? Feeder fund can be set up in any country. So you can have a feeder fund specific to Indian investors, Dubai investors, UK investors, which match our requirement, our tax requirement. Are all master fund registered in places like Cayman Islands? Generally, yes. So that you can buy and sell in tax havens. There is no taxation. If you look at Vodafone, I think so, Vodafone case, when Vodafone purchased Hutchison HR, they said the entire company is listed outside India. So we are buying and selling there, why should we pay tax? But IT department said, no, you're buying and selling, but the assets are in India. So you have to pay tax as per Indian requirement. Okay. I hope I have answered all the queries which have been asked. So this is kind of an example. Okay. So there are investors in US. Okay. There are certain foreign investors. Okay. They have created one feeder fund, one more feeder fund. All the money is going into the master fund. And who is managing that master fund? Investment manager. So Varun, answering to your query, you will create a feeder fund for US investor in US. That is in USD. And when it is converted into some other currency, there is obviously some risk, but that is managed by the investment manager. Right? That is managed by the investment manager. I hope everybody is good till this point. I am going to close the session for today.